This is the Haulin Assets podcast where we show you how to start and run your own trucking company. Ever wanted to go out on your own? Follow Chris as he goes through the highs and lows of running on his own authority.
Welcome, everybody. Welcome to the Haulin Assets podcast. I even said the right name this time, Chris. Sometimes I get mixed up. Okay, it's episode number 95. I am your host, Craig Hanks. Over there, he is Chris.
I feel like I should screw something up so we do a second take. It seems like we always need to do a second take of the intro.
Luckily, it's just the intro. Like I'll do a second take of the first 5 seconds.
Yeah,
because I run like 3 or 4 different podcasts, and so I'll say one of the other ones. Oops. Yeah. Well,
but this is your favorite one, right?
How could it not be?
You're lying on the air.
How dare you? How dare you? I would never do such a thing. All right, so today, episode number 95, we're talking about taxes. Taxes, Chris.
Yeah.
This is almost, I don't want to get carried away here, okay? This is almost as exciting as, creating a spreadsheet for savings plans or, I don't know what else, but spreadsheets abound, taxes. This is, I can barely contain myself.
I would rather plan a spreadsheet all day long than talk about taxes, but it's a necessary evil. You know what they say about life? There's only 2 guarantees.
Death and taxes.
Death and taxes.
Yeah, well.
We're not going to talk about death today.
I was going to say, please don't kill me. All right. So before we get started, of course, I want to encourage everybody to go to HaulinAssetsLLC.com where you can check out full show notes. You can get links and documents and all that stuff, especially the financials episodes, but even episodes like this one will probably have links for you to go check out. So please go there, find us on Facebook, leave reviews, subscribe on YouTube. You can check us out on YouTube and check out Chris's delightfully branded shirt, the Haulin Assets t-shirt, which you can buy.
Yeah, go to motorcarrierhq.com, their store on that site, and that's where you can buy the shirts.
Yes.
We'd appreciate it. Yeah, it's a little way to kind of help pay for the production costs of the podcast.
There you go.
Although we're in a pretty deep hole at this point.
Well, I don't like to hear that.
It's all right. It is what it is.
All right. So episode 95, the tax man cometh, Chris. It is, as we're recording February 1st. I'm sorry. This is live. You're listening to us live. It's February 2nd, 2022. And so taxes are going to be coming due within the next month or two for the vast majority of people in the country. So that's the impetus for wanting to talk about this. Chris, do you have anything you want to go over before we get into taxes?
Yeah, I want to talk a little bit about mistakes. Not really necessarily mistakes, but you know what makes me more upset than a mistake?
Fly in your soup.
No, I guess it depends on the mistake. But
okay. Right.
Actually, let me caveat that because mistakes in and of themselves don't really upset me. And in fact, most of the time, if like somebody that's working for me makes a mistake, they're probably not even gonna. I'm either not gonna be upset at all, or even if I am upset, they're not gonna know that I'm upset. It's just kind of one of those things. I expect mistakes to happen. They happen. No big deal, as long as they aren't like super egregious mistakes that are made because of negligence or mistakes that happen all the time, and people just continue to make them. And usually when they continue to make them, it's because they don't learn from them. And that's why like mistakes in and of themselves are a good thing. Because you make them, you learn from them, you get better. And typically, like I liken this, like I like to ski in the wintertime. It's the ski season. I'm skiing with my kids, in the last, we've been skiing a little bit in the last month. And one of them had a fall a little while ago, a little bit of a bad fall, no serious damage, just a little bit of pain. And pain's good.
That's how you know you're alive, Chris.
That's how you know you're alive. I was talking to him like, if you're not skiing hard and trying to get better, you're not going to fall. But if you're trying to push the limits a little bit, you're going to fall, and it just happens. And that's kind of the same thing I think in business. If you're not taking some risks, if you're not doing things, you're not going to make mistakes, but you're also not going to get better. So that making those mistakes is part of pushing the limits a little bit and trying to get better. So I expect mistakes to happen. I'm fine with mistakes happening. It's when one thing happens with a mistake that I really start to get mad.
What thing is that? There's There's like a single actual.
There's one thing with mistakes that really kind of
Okay.
that it gets me upset, and that's when somebody doesn't take ownership of their mistake.
Yeah.
You
Okay.
know, like they blame it on something else or someone else or some kind of circumstance or something like that. And you know, we in all of my businesses, we've had employees that do this. And in trucking, I've had, you know, employees that do this. And like I most of our employees in any business, they make a mistake, they take ownership of it, and I'm fine with that. But it's the ones that continually don't own up to the mistake that really make me upset. Do you know why that is?
Well, it's hard to get them to learn from it and to get better, right?
That's exactly the point.
Okay.
If you don't take ownership of your mistakes, and if you're always blaming it on circumstances or something else, then you're never going to learn from it because you don't think it's your fault. You don't think you contributed to that mistake. So you don't think there's a reason to learn from it.
Why would I change?
Yeah.
Okay.
So
why do you bring this up on this episode in particular? Is there a reason you're talking about it?
kind of two reasons, because I think in an organization, so if you're aspiring to have a fleet, to own multiple trucks and have people drive for you, or even just an owner operator that has a driver, and you're not the one driving the truck all the time, you have to have a kind of an environment in your organization where you are tolerant of risks. You allow them to happen, and you don't get upset when they do happen, so that people can make those mistakes and learn from them. I see this in the military all the time. The military is notorious for, a zero defect policy, and that's just not realistic. You can't have that. You have to realize people are going to make mistakes, and as long as they learn from them, okay. Like, there was one time one of our drivers a long time ago, it's been a little while, just barely skimmed the side of a dumpster backing into a super tight loading dock. There was a dumpster that was in a spot it shouldn't have been in. Hit it with, as he was kind of angling out, hit it with one of the drive tires, punctured the drive tire. That driver's been a great driver. Small mistake. I'm not going to get upset about that. Yeah. He's learned from it. He owned up to it. No big deal. But I've had another situation where a driver hit something, didn't own up to it. That makes me mad.
Yeah. Just, I don't know what happened there. Yeah. What do you mean? Oh, there's a dent? Oh my gosh. I don't know.
So one, just don't have that zero defect mentality. Things are going to happen. You have to be patient. And as an owner of a business, you can't get overly upset about things like that happen, because that's just kind of part of business.
Right.
Don't fall into the trap of treating a good employee poorly because of a mistake that they made.
Yeah. Okay. Well, fair enough. Although I think there is one place where you want to, if at all possible, make no mistakes. And that's your taxes, Chris.
That's your taxes. What a segue.
Do you like that?
Oh my gosh. I could fall off my chair.
Is it an 8.5? 9? Yeah. All right.
Yeah, somewhere around there.
Somewhere around there. So, Chris, is there anything else you wanted to say on that? Or should we move to taxes?
I say let's move to taxes.
Okay. All right. So this is our main topic for the day. Like I said, we're into February now. People are going to start doing their taxes. If you're an employee, you should have received your W-2 or 1099 if you're a contractor. If you're an employer, you should have sent everything out by now. So it's time to start actually getting into things. So Chris, how do you want to start the process of talking about taxes?
Well, let's talk a little bit about kind of why we're talking about this at this time. One, the most important thing you can do with taxes so that they aren't too big of a burden is to make sure you're well organized during the year and that you're on top of your bookkeeping and your accounting and all that stuff. If you stay on top of that stuff, the actual process of filing taxes should not be too difficult.
Yeah, but Chris, that sounds boring and hard.
It is boring. It shouldn't be hard. If it's hard, it's because you've made it that way, because you haven't stayed on top. You haven't stayed organized, and that's kind of your own problem.
Right. Okay. So stay on top of it. Take care of your stuff throughout the year. And we've talked about this many times in the past, right? Making sure that you maintain your records. I don't know if have we ever dedicated an entire episode to record keeping, bookkeeping, that sort of thing.
That's probably a good topic we should talk about.
I know we've skimmed over that topic.
We've definitely talked about it here and there, but we haven't had an episode that's really dedicated to that. But that's probably not a bad idea.
Yeah. So maybe, do we want to get into so when are taxes due? Because it's different for different business entities, right?
It is, and we'll kind of go over that. Let me talk a little bit. Yeah, let's talk a little bit about some of the things that we're going to cover today.
Okay.
I want to talk about when taxes are due, because it is different depending on a handful of things. We're going to talk a little bit about what kind of stuff you need to provide to your accountant. A few other things that you kind of need to keep in mind with your taxes. And then finally, we're going to talk a little bit about quarterly tax estimates, which is, if you haven't ever had to deal with that, it's something that can have a tendency to get people into a little bit of trouble. So we're going to talk a little bit about that. Hopefully, taxes, as you've alluded to, not the most entertaining topic that we're ever going to talk about.
This is not the sexy part of business ownership.
It's not the sexy part, but it's one of the things that's really critical. And hopefully this is one of those episodes that's going to give you some really good, actionable things that will help you in your business.
Yeah. All right. So we know what we're going to be covering in this episode. Let's start then with when you've got to do your taxes, Chris. So April 15th, that's tax day. End of story, right?
No.
Okay.
Yeah. If for your personal taxes, yes, that's when they're due. And taxes, I mean, this is a very complicated subject. What we're gonna talk about today is probably what, for the most part, is applicable to 90% of the people out there. Mm-hmm. So you definitely want to talk to an accountant, your CPA, or whoever about your particular situation. This is just to kind of help educate you so that when you do meet with your CPA, you're a little bit more prepared and things go smoother. And those guys that typically charge you by the hour, so the less of their time you can take up by coming prepared,
right,
the better off you're going to be.
That's not a bad, you kind of edged toward a disclaimer that wouldn't be a bad idea. We did this I think we had some lawyers on. We're like, by the way, Chris and I, not lawyers, also not accountants.
Yes.
So take everything with a non-accountant grain of salt and
Correct.
Go see your accountant.
Yeah. I've taken a lot of accounting classes, and over the years I've learned a lot about accounting, but I'm not a CPA. I'm not an accountant, but this will help out. So anyway, yes, for most people, your individual taxes are due April 15th. Most businesses operate on the calendar year, so from January to December.
Right.
But there are certain businesses, mostly with C corporations, where you can say, hey, I want my year to go from June or July 1st to the end of June. The military and the government goes from October 1st through September 30th of every year. That's kind of its year. So when you say taxes are due on April 15th, it's technically the fourth month after the end of the year, the 15th day of the fourth month after the end of the year. So that would be April 15th for individuals and for everybody that files
as a C Corp.
Well, no, as a calendar year. C Corps can be all over the place.
I see what you're saying. Okay.
So this is for the most part, if you're a sole proprietor, your taxes are going to be due on April 15th.
Mm-hmm.
For you individually, they're going to be due April 15th. Most other businesses, S corporations, partnerships, they're going to be on the third month after the end of the year, so March 15th.
Right. And so what you're saying is some businesses and some entities operate on a different calendar schedule. And so whatever the third month is when those taxes are due for those entities.
But again, for 90% of the people out there going off the calendar year, if you're a sole proprietor,
April 15th.
April 15th. If you're an S Corp, which is what a lot of small businesses are, or a partnership, you're going to be March 15th.
Okay. So
Haulin assets taxes are due March 15th.
Oh, really? Okay. All right. Well, that's good for you to know. So let's talk about, now that we know when we're going to need to file taxes, let's talk about how to do that. Now,
actually, before we get there, one reminder. This is if you have employees or you pay vendors, which most people do, you're supposed to mail out W-2s to your employees for their employee wage. Or if you've got vendors or your contractors, somebody that you pay a bill to, and there's different rules of when you have to send them out, but 1099s have to go out too, and all those have to be postmarked by the 31st of January.
Right.
So if you haven't done that yet this year, you're already late.
Oops. Okay. All right. So that's good to know. So when I say how to do it, what I mean is if you have a CPA, and if you're a business owner, it's probably a good idea to have a good, reliable CPA in your pocket. What do you need to bring to that person? What are they going to expect for you to kind of slap down on their desk? What documents are they looking for? Obviously, we talked about the W-2s, the 1099s, that sort of thing. But what else are they going to be looking for?
So the big thing is they're going to want to see basically all your income coming in and your expenses going out. So the easiest way to do that is if you're on top of your bookkeeping and use QuickBooks or some other accounting software, and you're entering in all your transactions, you reconcile that with your bank account so that you know everything's pretty accurate. Usually it's just a copy of your profit and loss statement. And QuickBooks and a lot of other accounting software, you can actually give your accountant access to your books. So they can actually go into QuickBooks and look at what you've entered in there, and they can kind of generate the reports and everything off of that. It makes things super simple for everybody. So you want to show them income and expenses. The easiest way to do that is with the profit and loss statement. The hard way that some people do is they just show them kind of their deposits or their checks that they get, and then they have a box of those, and then they have a box of receipts, and they give that to the accountant.
So now I'm putting myself in the shoes of an accountant, and I can imagine you get that box of receipts and checks or whatever, and on the one hand you're really annoyed, oh man, I got to put all this in. On the other hand, you're a CPA who's charging, oh gosh, hundreds of bucks an hour.
Yeah. And
so you're kind of licking your chops a little bit at this
billable hours, baby.
Foolish person who brought you a box of receipts to sift through.
Yeah. It's the billable hours.
Yeah.
They're seeing dollar signs. Ching, 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 ching.
Exactly. Okay. So do bring them a clean P&L.
Yep.
Don't bring them a box of receipts. What do you do, Chris, if, so we're coming up on tax season and somebody thinks, well, you know what? I actually haven't been very good about keeping my books this year. What do I do? Do I still go to the CPA, or do I spend a bunch of time trying to clean up my books before I go? What should that person do?
I've had that happen to me. I'm talking about this from experience. I've had the years. I've learned from my mistakes, and I hope you avoid the mistakes that I've made. And this is one of those situations where I hope you're avoiding that mistake. Is don't wait till the last minute. And if you do, you just kind of have to buckle down and do it. Like I've had times in the past where I've 1 week of my life has been consumed by getting ready to do taxes because I didn't stay on top of it.
Right. So you then need to go and get ready for taxes, meaning you're going to go sift through your documents. You're not going to take that box of receipts.
Yeah. I'm typically not the kind of person that wants to have an accountant do something that they're going to bill me a couple $100 an hour if I'm able to do it myself or have a bookkeeper that can do it at $15 an hour.
Right. Right.
It's kind of that simple.
Okay. So you mentioned you want to bring them the clean P&L. What about other documents that you've been keeping throughout the year? We talked about the profit and loss. What about the balance sheet and other documents that you've got?
So you're going to want to give them your balance sheet. You also want to give them any documentations for assets that you've purchased or sold. So if you've bought a truck and a trailer, you're going to want to give them the bill of sale so that they know how much you paid for it. Or if you sold it, same thing. They need to know all that so that they can do your books. Real estate too. If you've bought or sold real estate, they're going to need to know that. And then just also like things that are significant changes in the business, like if you've changed the business address, or if there's a change in ownership, like you've brought on a partner or you've got rid of a partner, all that stuff's very important for your taxes. So you need to make sure the accountant knows that kind of thing. Okay.
All right. Anything else that we need to bring to the accountant, or does that kind of cover it?
A couple things. If you say you've been in business for a year or a couple of years and you're switching CPAs, you're going to want to provide them your past years, like at least your tax returns. You're going to need to give them like a depreciation schedule for your assets. They're going to need to know what tax structure you're under. Are you an S corporation? Are you partnership, sole proprietor? All those kind of things.
So if you're switching to a different CPA or a different firm, is everything going to be pretty standard across the board, whichever firm you go to? Or like I imagine they're all going to be asking for the same documents, right? There's not going to be a ton of variation.
There's not a ton of variation. There will be a little bit of variation, but typically, but not a ton. And this list that I'm kind of giving you is definitely not all inclusive. So you're going to want to ask your CPA. You may want to come and say, here are the documents I know you need. What else do you need?
Right. Okay. Yeah. Once again, there's our disclaimer. We are not accountants. So talk to your accountant.
And I'm not your accountant.
You're not, wait, my accountant? You're not my accountant?
Yeah.
Okay. So anything else that we need to keep in mind as far as documents or dates before we move on?
Nope.
Okay.
That's about it.
All right. Sounds good. So, all right, Chris, let me ask you about another scenario. Right now, it's the beginning of February, but what if we're getting closer to April 15th? Oh gosh, it's getting down to the wire. I am not ready to file. And I need to file an extension. Personally, I've never filed an extension. Thank goodness I've never had to. But I know this is a thing. Is it difficult? Is it painful? Are you going to pay a fine? What's the deal with extensions? Give me the lowdown.
Personally, I have filed lots of extensions.
I want this noted on the record.
Better than me
for all time. Episode 95. Craig is more responsible with his taxes than Chris. Let it be known.
Let it be known. Yeah, I've had to file extensions quite a bit, and no, it's really easy to do. The thing that you have to keep in mind here is there's a difference between filing an extension to file your taxes versus paying your taxes. Just because you've filed an extension to file doesn't mean you don't have to pay them.
Can you file an extension to pay?
No.
No.
You still have to pay. So you have to estimate what you think you're going to owe and hope you're right.
Ugh.
And if you overestimate and you overpay, you'll get a refund.
Mm-hmm.
So I mean, it's not that big of a deal, but that's the hard part is you file the extension to file your return, and that's not a big deal. It's really easy to file that first 6-month extension. That's really not hard to do at all, and it's no big deal. It's not really much of a ding. Some people might argue that it might increase your chance of an audit a little bit, but I don't. Most people say that if it does, it's negligible.
Right.
But you still have to pay.
Okay. All right. So, Chris, I want to go back to something you mentioned earlier, quarterly tax estimates. This is something that I've heard about a lot, through the years as I have been an employee places, and I haven't had to worry about it. I'm not a business owner, but I keep hearing about quarterly taxes. You're talking about quarterly tax estimates. So this isn't something where you are paying taxes every quarter. You're just estimating. Tell me a little bit more about this and how does it work?
You are paying taxes.
Okay.
And so this is one of those things that is really misunderstood, especially for new business owners, because you're jumping from into a different world that you're not familiar with. So when you and I, let's take, for example, I earn a little bit of income for my time in the National Guard, a W-2. I'm an employee of the Utah Army National Guard. So I get paid just like any employee anywhere else. And that income that I get as an employee is subject to what's called income tax withholding. And basically what that is if you remember, every time you start a new job, you have to fill out a W-4.
Yes. Yeah.
And that shows basically how many deductions you want to claim. And they use that to determine how much money to withhold from your income to pay your taxes.
Right.
And so that money gets deducted every month. And if everything's perfect, you withhold exactly the amount that you owe. And when you file your taxes, you don't owe the government any more money, and the government doesn't, and you didn't overpay.
Right.
But usually what happens with a lot of people in those withholding situations is they overpay their taxes. And so then what happens?
Yeah, you get that refund.
You get the refund.
Sweet refund.
That's what a refund is you've overpaid your taxes.
Right.
And so basically you've given the government a free loan for a little while.
Thanks, buddy.
Enjoy that.
Yeah. All right. Okay, good. So let's see. So how does it work for a business owner then with the quarterly tax stuff?
So where your income that you earn as an employee is subject to withholdings, income that you earn in other categories that's not subject to withholdings, you need to do quarterly tax estimates in most situations. So I'm going to provide some IRS links in the show notes that will show kind of some of these quarterly schedules and a few other things in determining taxes that will be useful. So go check those out. But this is oversimplifying it. So in most situations, if you earn some of these incomes, you will have to file quarterly tax estimates. But if you don't, there's some exemptions to it. So it's not 100% guarantee you're going to have to pay it, but good chance you will. So here I've got them written down. If you earn interest income, if you earn income from dividends, if you buy or sell stocks and have gains or even other assets, you may be subject to pay quarterly tax estimates. Alimony that's taxable. And here's the big one that is going to apply to most people in the audience that we're talking to is earnings from business. So when you go and file that income tax return or that tax return for your business is going to show if you made a profit or loss. The taxes are going to show that. And if it made a profit, that profit for most businesses, today we're talking mostly about S corporations and partnerships. C corps are different. They pay their own taxes. But for what most of our audience does, small businesses, usually an S corporation or a partnership. So they're what's called disregarded entities. That means that the taxes, well, not disregarded entities, they're flow-through entities. And so what that means is the income from that business just basically flows right onto your personal tax return.
Okay, so are you saying that if my business earns a profit, then that profit is taxable as though it were income?
Yes, but it's not taxable by the business. The business doesn't pay the tax. So if you, let's say you and I own a business together and we're 50-50 partners, and that business earns $100,000 in profit throughout the year.
Okay.
When we file our taxes, it's going to show that the business made $100,000. And then the business and part of the taxes is going to issue what's called a K-1. It's a tax form that's going to show, okay, Craig, you get 50, you're a 50% owner. So 50% of that income or $50,000 is going to go onto your personal taxes. So that K-1, you have to give that to your personal accountant, and that will show that the $50,000 in income is your income and you're going to have to pay taxes on it. Same thing with me, because I'm a 50% owner. That other $50,000 goes onto my personal income, just kind of like you would when you file your tax return and you do W-2s for your employment income. The K-1s are basically like the income that you receive from the business.
So the major lesson that I'm learning here, I think, is that there's a reason CPAs get paid $200 an hour to figure all this crap out.
Yeah.
Right.
There's a reason.
My eyes are glazing. I'm trying so hard, Chris, and I'm losing my mind here trying to keep track.
Yeah,
the K-1s and the W-2s, the 1099s and the W-9s and blah, blah, blah.
There's a lot of forms.
It's so much.
Yeah, it is. It's a lot. And so this is one of those episodes where it probably wouldn't hurt to listen to it a couple times, read through the show notes a little bit, familiarize yourself with the terminology.
Then you get all of our wonderful jokes twice.
There you go.
How about
Have we
that?
said any jokes today?
Not really.
I don't feel like it.
This is not
dry.
This is not our most entertaining episode so far, but that's, you know what? They can't all be our most entertaining episode. So, Chris, sorry, I want to go back to the quarterly taxes, the quarterly tax estimates. Is that... What are due dates on that? If April 15th is our normal due date for taxes, is it every 3 months after that we're talking about it?
I didn't write this in my notes, and it's really dumb because it doesn't make sense.
Okay.
Because it doesn't go by like your traditional 3-month quarters. It's in the show notes. I've got a link to it in the show notes that shows what the dates are, but I know one of them's January 15th. I think one's like May 15th. One's
because that
June,
makes sense.
Yeah. Or not May. I think it's April 15th, June 15th. And then I can't remember, but it's weird because there's
go to Haulin Assets
a
LLC
2-month quarter,
for the full show notes.
Yeah. There's a 2-month quarter and a 4-month quarter and then 2 3-month quarters when it comes to filing these. So the timelines Go look at the show notes. Don't listen to the podcast. We're giving really bad info here.
This is where libertarians are born, Chris.
Yes. The stupidity of all this stuff.
Oh my gosh.
I do not know the logic behind why they did quarterly tax estimates.
You're begging the question here, Chris. You're assuming that there's some logic behind all of this.
Which there probably isn't. So let's take a step back and try to kind of circle this all together and talk about why this is important. So we talked about the K1, which shows how much profit
flows into your personal income.
Into your personal income.
Do you see that? I got it.
You got it. Good job. So in this situation where I've got $50,000 of my personal income from the business, I'm going to have to pay taxes on that. And say my tax bill for this year is, let's just say it's $10,000.
Okay.
That $10,000 is what I have to pay. So the first year you realize a profit, the IRS is going to look at that and said, hey, you paid $10,000 in taxes this year. Next year, I want you to set that profit or that tax amount aside so that you don't end up a year down the road with a $10,000 tax bill that you can't pay.
Right.
And so that's what those quarterly estimates are. Is I'm simplifying this. You paid $10,000 in taxes this year. So roughly at each one of those quarterly due dates, you're going to need to pay $2,500 each time to make that $10,000 throughout the year, so that that's the equivalent of the withholding that you had in your paycheck when you were an employee.
Got it. So that's
except
what we're
for you
talking
have
about
to proactively do it. Somebody's not doing it for you.
Okay.
You've got to do it yourself.
Fun.
Yeah, and you can kind of you know, depending on how disciplined you are with money, you can kind of play around with that just a little bit. Like say you had a really good first quarter, and so maybe you pay a little bit extra. You had a really bad second quarter, so maybe you don't pay any or you pay a little bit less. You just want to make sure that you're withholding enough to pay. And you, if you don't do it right, you'll get penalized, and you have to pay the IRS a penalty. And again, talk to your CPA, but basically how it works, and there's some exceptions to this. If you withhold 100% of what your tax bill was last year, so if at the end of the year you've withheld a full $10,000, which is what you paid in taxes last year, you're not going to be penalized. If you're in a higher income bracket, like I think $75,000 if you're filing single, $150,000 if you're filing jointly, if you're that high or higher, then it has to be like 110% of what you paid last year. And as long as you do that, you're not going to get penalized.
Okay.
But if you don't meet those metrics, you can get penalized. So that's where you want to make sure you're talking to your CPA. And even worse than getting penalized is being short on your tax bill and not having the money to pay it and being in debt to the IRS. That's the last thing you want to do.
See, I was just going to ask about that. What happens in that case? Has this ever happened to you, Chris?
No, I have never missed a tax payment.
That's good.
And I want to keep it that way.
So what if somebody does? What if, okay, so I started my trucking business, 8 months ago. I've been going, things are going okay, but I haven't been saving up enough in my tax savings account, or whatever I'm going to pay it out of.
Yeah, it's nasty. That's where the IRS gets nasty. That's where you hear the horror stories about the IRS, and they'll put liens on you, tax liens, which are federal tax liens, a terrible thing. We deal with those on a fairly regular basis at iThrive Funding, my factoring company, with clients that apply for our services, and then we go in and we see that they've got a tax lien. I mean, those are just things we can't work around.
Yeah,
they've got to get paid. And you'd be surprised how often we see it.
Oh, I mean, when I worked in banking, I used to work in the bank storefront kind of thing, right? And I can't tell you how many liens I had to put on personal accounts, and it's painful. It's not nice to do. It's not nice to experience.
Yeah. So again, we talk a lot about saving for engine blowouts or other big repairs for your trucks. You need to make sure you're setting aside money for taxes.
All right. Well, Chris, that's a pretty good rundown. I feel like we've covered quite a bit of ground here. Is there anything else that we need to go over before we wrap up this particular topic?
Get professional advice. We're not tax professionals. How many times have we said that now? Have we said it enough?
Not enough.
Attorneys going to be happy with this episode with all the disclaimers we've done?
It's all of the other times throughout the show, through 94 episodes, all the times that you've said, save your money, keep track of your books, whatever, those things that you're always saying every episode. We need to say, go see a tax professional that many times in this one episode.
Oh man, that is hurt.
Yeah. Well,
that'd be like 100 times.
So yes, please go see a tax professional. So as we wrap this up, I think we do have an impact tip. I looked ahead, Chris. I cheated. I looked at the impact tip, and I'm interested to see what you'll do with this one. So what's our impact tip today?
Start working on your taxes early.
Okay. I feel like we've talked about this.
We have, yeah. So we're staying right with the subject.
All right.
Start working on your taxes early. And to me, that early means I think, because the problem is you can't, it's not a good idea. And I don't feel like it's professional or fair to your accountant to go to your accountant the day before taxes are due and say, hey, here's all my stuff.
Well,
and my taxes.
And they're almost certainly going to say no.
Yeah.
Go home, do your own taxes. Get on TurboTax.
Yeah, talk to your accountant, but you should have that information to them a month before it's due.
Right.
And that should give them enough time to get everything done so that it's all done on the due date.
Okay. All right. Fair enough. And also, if your neighbor is an accountant, do not talk to them from approximately March 15th to April 15th, probably February 15th.
I would say don't talk to them from about the end of January until April 15th, April 16th. You can talk to them on April 16th.
On April 16th, yeah, then
they'll probably be asleep. You won't be able to wake them up, but you can at least try at that point.
It's one of those that, it's a bit like school teachers, right? Where people like to make fun of school teachers for working 9 months out of the year, right?
Yeah.
I feel like tax accountants, they earn a year's worth of pay in about 2 or 3 months of work.
Yeah.
I'm joking,
tax accountant for that. Yeah. They work hard in that 3-month period. It's brutal.
Sounds awful.
Yeah.
Honestly. Okay. Well, Chris, thanks for the good rundown on this one. And I hope this was helpful to everybody. Like you said, go back and listen to it twice. If you feel like there were some terms, there were some form names that you want to stay refreshed on, this would be a good one to hit up twice. Other than that, please go to HaulinAssetsLLC.com, where we will have not just the full show notes for the things we went over today, but links to a lot of those things. The forms, probably link where to file an extension and that sort of thing. That'll be at HaulinAssetsLLC.com. Please leave a review based on other more interesting, exciting episodes. Give us 5 stars. Or 5 stars based on this one. I don't know. How did we do, Chris?
Yeah, I think we did pretty well. But the more reviews, the better. We appreciate that.
So, thanks everybody for listening, for watching on YouTube, and we will see you all in 2 weeks.
We'll see you then.